Let me ask you something. When you first got into trading, what did you believe success would look like? Most people imagine big wins, big positions, big profits. Maybe you thought, one good trade can change everything. Or, if I just risk more, I'll make money faster. And honestly, that belief makes sense. Because everywhere you look, trading is marketed as fast money. Screenshots of huge profits, stories of accounts flipping overnight, people turning small balances into massive ones in days. But here's the truth, most traders learn the hard way. Trading big is one of the fastest ways to lose everything. And trading small, patiently, consistently, almost boringly, is how most profitable traders actually survive and win long term. Today, we're going to talk about why trading small is more profitable than trading big. Not in theory, not motivational quotes, but in reality, psychologically, emotionally, and mathematically. If you've ever blown an account, if you've ever felt panic in a trade, if you've ever wondered why consistency feels so hard, this video is for you. Part 1. Why traders are attracted to big trades. Most traders don't start by wanting to trade big. They start by wanting results. And when progress feels slow, when wins feel small, when the account balance barely moves, that's when the temptation shows up. The temptation to increase lot size, increase leverage, risk more than planned. Because deep down, many traders are not trading for consistency. They're trading for relief. Relief from financial pressure, impatience, feeling behind, wanting proof they're good enough. So trading big feels like a shortcut. If this trade works, everything changes. But here's the dangerous part. The market does not reward urgency. The market does not reward desperation. The market does not care how badly you want it. When you trade big, you're no longer trading probability. You're trading hope. And hope is one of the most expensive emotions in trading. Part 2. The psychological weight of big risk. Let's talk about what actually happens in your mind when you trade big. Not what you think happens, but what really happens. When the risk is small, your mind is calm. You can follow your rules, let the trade play out, accept the outcome, think clearly. But when the risk is big, everything changes. You start watching every candle. Every tick feels personal. Your heart rate goes up. Your breathing changes. Suddenly, you're not analyzing. You're reacting. You move stop losses. You close trades early. You hesitate on good setups. You jump into bad ones. Not because you're undisciplined, but because your nervous system is overloaded. Your brain interprets large risk as danger. And once your brain senses danger, it prioritizes survival, not logic. This is why traders who risk too much break rules they swore they'd follow, revenge trade, overtrade, spiral emotionally after losses. It's not a character flaw. It's biology. Big risk hijacks your decision-making. Part 3. Why big trades feel good until they don't. Here's something most traders won't admit. Big trades feel exciting. They make trading feel meaningful. They give you adrenaline. They make you feel in the game. And that's exactly the problem. Because excitement is not clarity. When trading becomes emotional stimulation instead of execution, you stop behaving like a professional. You start behaving like a gambler. And gamblers don't manage risk. They chase feelings. The market will occasionally reward this behavior. You might win big once, maybe even twice, but eventually, the same behavior that created the win will create a loss even bigger. And that loss will hurt more than the win felt good. This is how accounts are blown, not in one moment, but through repeated emotional decisions fueled by oversized risk. Part 4. Small trades protect your mind first. Here's a truth most people miss. Trading small isn't about money. It's about protecting your decision-making ability. When risk is small, losses don't damage your confidence. Wins don't inflate your ego. You can stay neutral. You can stay patient. And neutrality is power in trading. Because the best traders are not emotional. They are responsive, not reactive. Small risk allows you to observe patterns clearly, execute without fear, accept losses without spiraling, stick to your plan consistently. This is how discipline is built, not by forcing it, but by creating conditions where discipline is possible. You cannot expect calm behavior while placing stressful risk. Part 5. Why consistency comes from small decisions. Most traders think consistency comes from better strategies. But consistency comes from repeatable behavior. And repeatable behavior only exists when risk is controlled, emotions are stable, expectations are realistic. Small trades allow you to show up the same way every day. You don't need to recover from emotional damage. You don't need to make it back. You don't need to force trades. You simply execute. And execution, repeated over time, is what separates traders who last from traders who burn out. Part 6. The beginning of a real trader mindset. Here's the shift that changes everything. Stop asking, how much can I make on this trade? Start asking, how well can I execute this trade? Small trading is not weak. It's mature. It says, I value longevity over excitement. I value process over outcome. I'm here to survive first, then grow. And survival is the first job of every profitable trader. Part 7. The math most traders ignore. Now let's talk about something traders avoid. Math. Not complicated formulas. Just reality. When you trade big, your margin for error shrinks. A few losses in a row, which is normal in trading, can destroy your account. But when you trade small, losing streaks become manageable. Let's say you risk a small percentage per trade. You can lose 5 trades, 10 trades, even more, and still be in the game. That's the difference. Trading is not about avoiding losses. Losses are guaranteed. Trading is about surviving losses long enough for your edge to play out. Small risk keeps you alive. Big risk shortens your lifespan as a trader. Part 8. Drawdowns and recovery. Here's something most traders don't think about until it's too late. The bigger the loss, the harder it is to recover. If you lose 10% of your account, you need about 11% to recover. If you lose 30%, you need over 40%. If you lose 50%, you need 100% just to break even. Big risk creates deep drawdowns. Deep drawdowns create desperation. And desperation creates bad decisions. Small risk keeps drawdowns shallow, which keeps recovery realistic. Professional traders obsess over this, not because they're afraid, but because they understand math doesn't forgive wreck. Clessness. Part 9. Why professionals trade small. Here's a reality check. Professional traders are not chasing excitement. They're managing businesses. They care about capital preservation, stable performance, predictable risk, a long-term survival. That's why professionals think in probabilities, not individual trades. They know 1 trade means nothing. 10 trades mean little. 100 trades reveal the edge. You cannot think this way if you're risking too much on each trade. Big risk forces you to care too much about single outcomes. Small risk allows you to zoom out and case statistically. Part 10. Small trading builds real confidence. Let's talk about confidence. Most traders want confidence before they trade small. But confidence comes after consistent execution, not before. Small trades allow you to prove to yourself you can follow rules, build trust in your process, detach from outcomes, stay emotionally stable. This creates earned confidence, not hype, not ego, not one lucky win, but calm certainty. And calm traders make better decisions. Part 11. why big trading feeds ego, not growth. Big trading often feeds the ego. It makes you feel bold, brave, special. But ego and learning don't coexist well. When ego is in control, losses feel personal. Feedback is ignored. Mistakes are blamed on the market. Growth stalls. Small trading humbles you. It keeps you focused on improvement, not image. And improvement is where profitability lives. Part 12. The real goal is not more money. This might surprise you. The goal of trading is not to make money. Money is the result. The real goals are consistency, discipline, emotional control, risk management. When those are strong, money follows naturally. When they're weak, no amount of strategy can save you. Trading small strengthens the foundations. Trading big tests foundations you haven't built yet. Part 13. How to actually apply this. Here's how you apply this mindset practically. Reduce your risk per trade. Focus on execution, not outcome. Journal emotional reactions, not just results. Measure success by rule following. Accept slow growth as real growth. This is how traders top restarting and start progressing. Part 14. The trader who lasts. The traders who succeed are not the smartest. They're the ones who last. They understand. Boring is sustainable. Small edges compound. Discipline beats excitement. Survival comes first. They trade small because they think long-term. If you take one thing from this video, let it be this. Trading small is not fear. It's respect. For the market. For risk. And for your future as a trader. The market will always be there. Your capital and your mindset won't be if you don't protect them. Trade small. Stay calm. Stay consistent. That's how real profitability is built. If this video helped you rethink how you approach risk and consistency, this channel is for you. Here we focus on mindset, discipline, and long-term trading success, not shortcuts. Subscribe and stay with us as we build the profitable trader mindset together.